Good afternoon, everyone, and a very warm welcome from us here in the AIM investment team. And thanks for joining the very first Blackfinch AIM in Focus webinar. As a brief introduction, my name is Josh, and I'll be your host for these webinars going forward as we look to dissect the AIM market together. I act as the product specialist for our listed investment solutions here at Blackfinch, which includes the AIM portfolios, our multi-asset investment, and our real asset strategies. And I'm joined today by Head of AIM Investment, Chris Swanepoel, and Investment Manager, Lawrence Campin. And I think let's introduce them straight away. So, Chris, a very warm welcome from us all here. If you wouldn't mind telling us just a bit about yourself, but more importantly, why the AIM market?
Well, thank you, Josh, and I welcome you all to our inaugural AIM Quarterly. What attracted me to the small cap investment 25 years ago was really the engagement with the businesses you invest in. This is not something you experience in the large caps, investing in funds or even funds of funds or bonds. We are able to engage directly and almost on a daily basis with management and, more interestingly, founder managers of these companies. A very exciting and great place for a stock picker with different and interesting businesses and characters that create jobs and add real value to the economy. I'll hand you over to my partner in crime, Lawrence, for a brief introduction.
Thanks, Chris, and good afternoon to everyone. So I'm Lawrence, investment manager at Blackfinch, and I solely work on my AIM proposition. So I've been at Blackfinch for just under 5 years now, during which time I became a CFA charter holder. So the very nature of companies listed on AIM is what really drew me to the market, as well as the opportunity to build an understanding of companies that are often less covered by analysts. This may sound cliche, but no 2 days are the same. Josh, I'll hand back to you.
Thank you both, and thank you for joining. It's great to have you here with us today. So if we do a quick run through the agenda before we begin, we'll start by running through why a client may consider the investment case for the AIM market. And then once we've done that, we'll think about the state of play currently, meaning where are we today, how do we get here, but more importantly, what's the outlook going forward? Afterwards, I'll hand the baton over to Lawrence, who's going to give you some nuggets on what we're hearing on the ground floor and engaging with AIM companies. And then finally, over to Chris, who's going to touch on the upcoming and very infamous autumn budget with final comments. So this really is going to be an action-packed first webinar. The goal here is to arm you with information either to take into existing client meetings or, considering current valuation levels, why now might be the time for a client to consider the AIM market. Some final housekeeping before we begin. Do remember that our comments doesn't form investment advice, including any potential investee companies discussed throughout the webinar. And of course, we're on hand to discuss any of the topics mentioned at a later stage. And you're more than welcome to ask relevant questions for us to debate in these future webinars. Just use that link contained in the sign-up page for a bit more detail, but just in case, the email is eventswebinars@blackfinch.com. Now then, just to set the scene in terms of the AIM market and the role it plays for the UK economy, and then after I'll run through the state of play for investors. So, of course, if you're going to check global returns, you can clearly see that there's a dispersion between the likes of your US tech giants like the Magnificent Seven and UK smaller companies, including AIM. But before we dig into why that's the case, I think it's important to remind ourselves, first of all, why does the market exist in the first place at all? I think that's going to help us understand current dynamics. So AIM was founded over 30 years ago with a very simple goal, and that was to create a thriving market that can give these smaller growing companies the chance to raise capital for growth. And in return, these investors can then unearth hidden gems in the UK market that can give you a strong return on investment. And they could be the next Jet2, YouGov, Fevertree, whose roots all stem from this market. And I'm sure some of you may have had a little smile when I say strong returns for the AIM market, and I promise I will dig into that in just a moment. But as investors, we need to understand that some of these companies, they are high growth names with great upside potential. And accounting for market conditions and the resultant tail or headwinds they may bring remains vitally important. But if we just take our investment hat off and think more broadly about the role that the AIM market plays for the UK economy, just looking at 2023 in isolation, AIM companies attributed circa 36 billion in gross added value to UK GDP. It directly supported more than 410,000 jobs. And if you think about it in productivity terms, AIM company employees typically are more productive than the national average, with productivity of circa £87,000 per employee compared to 58 with the average. So you can see that there's a real role and need for the market, both in terms of supplying capital to these smaller companies for growth and driving those investment returns, but also the added value to the wider UK economy. And then let's not forget those IHT benefits on top for an investor. To touch on them very briefly, if you're considering this from a tax planning perspective, AIM-listed shares can qualify for 100% business relief, meaning the value is excluded from a client's estate for IHT purposes after 2 years of ownership, provided those shares are still held at the time of death. And this really is going to reduce their IHT liability, where they'd usually be charged 40% on estates over that tax-free threshold. But just before I hand over to Lawrence and touch on what we've been hearing on the ground floor of AIM, for those that haven't been following the market, it's important to understand where valuations are today. And listed markets really have shown an acute level of sensitivity to macroeconomic factors in recent years, where your inflation prints, your interest rate decisions have dominated returns rather than the more historic change in company fundamentals. And then this inflationary shock that took hold of markets in 2022 really did create further pressure on smaller companies, including AIM. Now, many smaller companies, they utilize borrowing and capital raises to fund future growth, and a sharp monetary tightening cycle restricts this, and it can cause share prices to fall more harshly relative to global peers. And that's what we saw across the AIM market, where investors indiscriminately sold out of AIM-listed stocks, regardless of these fundamentals, in pursuit of safety, whether that is into the more global large-cap stocks on diversification grounds, or even some seeking to exit the market to lock in yields on money market funds, since these became incredibly attractive as interest rates climbed. And this brings us up to this year and the state of play currently. We saw a spring/summer rally as interest rate cuts started to price into markets, and that did help boost investor sentiment. But over Q3, this last quarter especially, we have seen a real sogginess in the entire UK SMID and AIM market, which has been weighed by the upcoming autumn budget and then what implications that may bring. And this has caused some unrest for investors, as well as increasing uncertainty for both consumers and businesses. But Chris is going to give some good insight in the outlook and our view on the AIM market, as well as the budget. But before we do that, Lawrence, I think there's no better person to talk to for us to understand really what's going on with AIM companies in the ground floor, as you've really got your finger on the pulse here. So I'll pass over to you.
Thanks, Josh. So over the past few months, we have seen some insider selling activity from companies across the AIM market. And we do believe this may be related to the uncertainty of, as Josh has said, the upcoming autumn budget. So an example of this from the growth portfolio is Tradeware, a leading value cycle software solution provider to the US healthcare industry. So despite releasing results ahead of expectations in September, a group of insiders, including the co-founders, sold approximately 13% of their aggregate holding. So management confirmed in the results call that this was driven by demand for a long-term holder, but also with one eye on the autumn budget. We have also observed an increasing number of companies in the market flag slower customer decision-making, with sales cycles extending. So in many cases, revenue has been deferred into subsequent financial years. And in these circumstances, we do believe looking at the balance sheet strength is an important consideration, and that can give a business the time to trade through the headwinds. So providing the product or service offering remain competitive in the marketplace, and the market fundamentals are expected to recover in due course, we do believe taking a long-term supportive view can be a sensible approach. And finally, one theme which gives us confidence in the value on offer in the AIM market is the continuous stream of takeover announcements. So companies such as Smart Metering Systems, Alpha Financial Markets, and Keyword Studios, they have all been or in the process of being taken over by private equity at significant premiums to their last undisturbed price. So we expect these takeover approaches may continue in the near term and help provide catalyst for the market. I'll now hand over to Chris to cover the outlook of the market.
Thank you, Lawrence and Josh. I'll pick up on a few themes touched on by Josh and Lawrence. The first, and the elephant in the room, will be the autumn budget. Now this may affect AIM stocks. I have to start by saying that in the last 19 years of investing in AIM, I've been dancing this dance every single year through Labour, the coalition years, the Tory government, and now back to Labour. Will they, won't they remove inheritance tax relief from AIM stocks? The answer, we simply don't believe they will. AIM is a success story in the UK and one of the longest lasting and successful growth indices in the world. The government need to attract investment and capital into the economy, and AIM achieves this. Josh touched on the recent Grant Thornton report commissioned by the London Stock Exchange on the economic impact of AIM companies. A very interesting read indeed, containing a myriad of facts. Josh already mentioned the over 400,000 jobs AIM companies support directly, and in addition, through the supply chain expenditure, a further 212,000 jobs. This is closer to home than we think, as this includes advisors to these companies and even us as fund managers, as well as the thousands of businesses in the supply chain. It equates to a combined 65 billion of gross value added to the economy. AIM also contributes 5.4 billion of direct corporate taxes. A success story indeed, and I for one do not think that they will kill the goose that lays the golden eggs. Another theme of late is uncertainty brought on by an earlier than expected election, change of government, and the aforementioned budget. The markets hate uncertainty, and we have had loads in recent months. From changes in policy rolling back on net zero targets and causing selling pressure by uncertainty about capital gains tax charges. We have seen troubled markets before, and it is certainly not new. During my tenure in small caps, I've seen this post the tech boom and bust in 99-2000, leading into 9/11 and then the spectacular recovery once the Iraq invasion started in early 2003, and running into the global financial crisis 5 years later in 2008. Once again, a spectacular recovery where we saw AIM do especially well against large caps through the Grexit and Brexit years, and then more recently the COVID sell-down and sharp recovery once AIM stocks recovered especially well. We firmly believe that we are entering a more stable period with the interest rate cycle normalizing and also clearer signals from government on policy which makes for clearer decision-making and certainty in spending and where businesses can allocate capital. We can see a clear recovery in sectors such as the building and construction sectors, especially in house building with strong policy backing, in defence spending with the current geopolitical tensions certainly not abating, in education and in infrastructure spending. Think rail operating companies simply not spending at the moment due to uncertain future on nationalisation and energy and new energy capital spending, all benefiting from clear policy direction and interest rates normalising. Many of our AIM companies provide services into these sectors and others such as healthcare and digital transformation. And we believe that the quality and compelling valuation of these businesses will shine through and be reflected in the share prices in the months and years to come. Thank you all for watching. I hope to run into you in person very soon. That's all from me, and back to Josh.
Thank you both. And may I say some great insights there. So that's everything for the Q3 AIM in Focus webinar today. So thank you, Chris and Lawrence, for joining us, but more importantly, for all of you tuning in. I do hope you've got some nuggets to take away to your client meetings this week and beyond. But of course, if you've got any questions off the back of today's content, do feel free to contact your business development manager, and we'll make sure that we get back to you as soon as possible. But the next webinar will be held on the third Thursday of every new quarter, which in this case will be Thursday the 16th of January, all at the same time of 1 p.m. We really do look forward to seeing you there. And bye for now. Take care.